What a year 2019 was, one of the best ever. Very uncommon to see both stocks and bonds up as much as they were. And a lot of people experienced significant returns in their balanced portfolios, more so than in any other year.
Stocks being up over 30% for 2019, bonds being up 9%. Very rare that they're both up that much. You're talking about, roughly 10th percentile outcome for most diversified portfolios. That typically only happens coming out of a tech bubble scenario or coming out of a global financial crisis type scenario. And there's typically only one force strong enough to push bonds and stock prices up that much in that short a period of time, and it's usually the Fed. It's usually central banks. They have the power to bid up bond prices, suppress yields, and force people into stocks and cause everybody to stop caring about risk and volatility. And so
Valuation and fundamentals.
And valuations and all that stuff. So there's no doubt the Fed was probably the biggest factor. Their pivot throughout the year was huge, huge.
Earnings growth was a big item this year. Basically, lack thereof. Started with an expectation coming into 2019 of around 10% earnings growth. Basically got zero earnings growth for the year. On the revenue side, I think we were only up maybe 3.8% in revenues. And then with wage growth and other things and share buybacks, give perspective on how the actual fundamentals of those numbers compare to the returns we got.
Yeah, so if you just go out and buy the S&P 500 index, your returns are really only going to come from a few places. You get earnings growth, which we got none. So keep in mind, we're trying to build up to a 31.5% return. So your first component, earnings growth, your most powerful component, is 0. Your dividend yield is 2. Your share buyback yield is 3. So we've got 5. So what accounted for the rest of it? It's all just multiple expansion. That means, you have a price to earnings ratio. How much are you willing to pay for a dollar of earnings? People are willing to pay, over 25% more for a dollar of earnings at the end of the year as they were at the beginning of the year. If you look at who's sort of the largest marginal buyer of U.S. stocks over the past few years, it's been U.S. corporations. And so last year we had a record year of share buybacks, about $1 trillion. This year it looks like we're going to come out somewhere around $800 billion, which is still a huge year. And it's the only reason why we've thus far avoided an earnings recession. Companies are borrowing money very cheaply, and they're taking that cash and they're buying back their own stock. And so they're increasing their earnings per share, not by actually growing their earnings, but just by reducing the number of shares outstanding. And so that force and the Fed have definitely created a huge disconnect between economic reality and the prices of almost all financial assets, bonds and stocks.
So give us some insights as to what stocks did really well during the year, and tell us a little bit about the market cap of some of those stocks.
Yeah. So you had large cap stocks outperforming small cap stocks basically throughout the year. As far as what didn't do well, there really weren't many places that did poorly. If you take the S&P 500, there are only about 100 stocks that were up less than 10%. So there were a lot of home runs out there. Half of the stocks were actually up more than 30%. And then you had some really big stocks. So Apple, Microsoft, Amazon, Google. I mean, those stocks are over 5 trillion in market cap right now. And so that's larger than the entire small and mid cap universe combined.
So 5 stocks compared to how many stocks in that universe?
Yeah, close to 3,000.
Okay.